Welcome everyone to this Monday edition of Inside India. I'm Sri Jegarajah. Here are your headlines. US Vice President J.D. Vance heads to India today, where he will be meeting with Prime Minister Narendra Modi as India looks to move quickly in securing a trade deal with the United States. Fitch Ratings downgrading its growth forecast for India amid the escalating trade war. And Trump's attack on the Fed sending the US dollar sliding, but dollar weakness providing some support for the battered Indian rupee. Welcome everyone. The Indian markets join us in about 45 minutes time, and Q4 earnings season, by the way, will be hitting full stride. So with that, let's take a look at Gift Nifty futures to see what they are indicating. Remember, the markets were closed on Friday for the Good Friday holiday. Nifty futures are looking like this: 23,838. Where we left off on Thursday was 23,851. And in terms of the market action, the setup looks reasonably constructive. The Nifty, the benchmark Nifty 50, ended with gains of up to 4.5% last week. So levels of 23,500 and 23,350 seen as key support zones. In terms of resistance, that's being pegged at around 24,000 and 24,200. Q4 earnings season, as I said, hits full stride this week. Some big names are reporting, and it appears that the narrative is one of tariff de-escalation, which ought to work in favour of the Indian markets. Trading is thin in Asia today, so markets remain closed for Easter Monday. Australia, New Zealand and Hong Kong are out of play. The markets that are open are looking like this. Quite a mixed picture. The Nikkei is on the defensive, down by about 1.25%, but we are seeing some resilience and strength elsewhere, especially in Australia and here in Singapore. The Straits Times Index up by 1.2%. However, TAIEX, as you can see there, one of the laggards today, down by 1.2%. Now, one of our top stories today: US Vice President J.D. Vance and his family are set to land in New Delhi soon. Vance is heading to India after meeting the Pope in the Vatican. VP will hold talks with Indian Prime Minister Narendra Modi today. This comes as India is rushing to sign a trade deal with the US as early as possible. Modi and Vance are expected to review progress made on the bilateral agenda outlined in February. In the meantime, the International Monetary Fund and the World Bank kick off their annual spring meetings today. Ahead of that, IMF Managing Director Kristalina Georgieva spoke about the impact of the tariff environment, and she welcomed India's decision to reduce trade barriers and added that it would add to the country's growth prospects. But when it comes to the global economic growth outlook, the IMF is expecting notable markdowns.
Ultimately, trade is like water. When countries put an obstacle in the form of tariff and non-tariff barriers, the flow diverts. Some sectors in some countries may be flooded by cheap imports. Others may see shortages. Trade goes on, but disruptions incur costs. We will quantify this cost in our new World Economic Outlook, to be released next week. In it, and I see our chief economist right here, he would make the presentation. In it, our new growth projections will include notable markdowns, but not recession.
Elsewhere, Indonesia is also taking measures to boost prospects of trade negotiations with the United States. And JP Ong joins us with the details now. Hi, JP.
Good morning, Sri. And it seems that trade is the theme for Monday in Indonesia as well, especially on the against the backdrop of Indonesia kicking off those trade talks with the United States to avert that 32% reciprocal tariff that could be levied on Indonesian exports to the world's largest economy. Now, according to Chief Economy Mr. Airlangga Hartarto, he said that this is the first in a series of negotiation rounds with the U.S., which they will conduct over the next 60 days to try and bring down those tariffs and try to at least even out the trade balance that tilts heavily in favor of Indonesia. Among the things that they're planning to import more of are U.S. energy imports, such as oil and natural gas. Now, this is important because keep in mind, Indonesia was an early member of OPEC and about 50 years ago was a major producer of oil and gas and exporter of oil and gas. But we've seen how that swung actually because of Indonesia's status now as a net energy importer. And if they start to import more energy from the United States, it means that they might even become even more of an energy importer in the future. Also a stark reminder of how things have changed for Indonesia. And we also mentioned that this is also important because later on today, we're expecting trade data from Indonesia for the month of March, with the trade surplus expected to narrow to about $2.6 billion US dollars, according to economists surveyed by Reuters, and exports expected to also drop by 3.6% on a year-on-year basis. If that does come true, it means that Indonesia will continue to face more of an uphill task, actually, in terms of helping improve their trade and exports outlook, because the possibility of these tariffs from the United States might make it more difficult for Indonesia to sustain any improvement on the export front, and also might lead to more pressure on the rupiah. We did note earlier on today that the dollar index has weakened in favor of many of these Southeast Asian currencies, but take a look at the rupiah in today's session. They're not gaining as much as some of their peers in Southeast Asia, also pointing to perhaps the delicate nature and how sensitive the rupiah has been in recent years to this volatile trade balance picture in Indonesia, which could be exacerbated should trade talks with the United States not succeed over the next 60 days. Sri, it's back to you.
JP, excellent. Well, thank you very much indeed for that. And that really parallels expectations and the narrative as it applies to US-India bilateral trade agreement. A lot riding on this. Let's take a quick look at how US equity futures are shaping up. It looks as though it's going to be a day of negativity this Monday. Remember, we are in the thick of earnings season, so the guidance risk is a challenge for the major indices. US dollar also weakening sharply after Trump ramped up attacks on the Fed in recent days. White House's economic advisor Kevin Hassett telling reporters late last week that the Trump team has been studying options and the possibility of firing Fed Chair Jay Powell. His comments coming after President Trump accused Powell of, quote, playing politics by not cutting rates. But over the weekend, US Senator John Kennedy, a Republican member of the Senate committee that oversees the Fed, spoke out against the Trump administration, stressing that the US central bank needs to be independent. Here's what he said on NBC's Meet the Press on Sunday.
I don't think any president has the right to remove the Federal Reserve chairman. I think the Federal Reserve ought to be independent. I think that Jay Powell and President Trump need to sit down and once again have a hug and a cup of hot cocoa and work it out. My experience with Jay Powell is that he's got tiger blood. He's going to do what he thinks is right. And he's not going to go down in history as the Federal Reserve chairman that allowed inflation to become wild as a March hare. And he's going to do what he thinks he's got to do.
Good cup of cocoa can solve a lot of the problems. This as CNBC survey of Americans found his approval ratings on the economy dropping to the lowest of his presidential career, with only 43% in favour of how he's handling the economy. And overall, a majority, 51%, disapprove of his handling of the presidency. Right, coming up next, we'll turn the focus on India's private equity space. Are the new age companies in India worth investing in? We'll discuss that with Karthik Reddy of Bloom Ventures. Stay tuned. Welcome back to Inside India. Fitch Ratings has downgraded India's economic outlook to negative, citing the worsening global trade war. They warned that India's high inflation and weak fiscal policies are increasing risks to its economy. The trade and tariff noise could also impact the VC environment in India. According to a report from EY, the beginning of 2025 saw a positive momentum. EY says in January, PE investments rose 37% month on month. However, exits still remained tough, seeing a 48% decline in that period. India still emerged as a hot VC destination in 2024. Helped by strong domestic markets, this even as global funding remained flat. All of that, though, was before the outbreak of the trade war. Let's bring in Karthik Reddy now, co-founder and managing director at Bloom Ventures. Karthik, great to have you on the programme. Can we start with your thoughts on the climate for fundraising? And is there any evidence that venture capital is pulling back and is perhaps even another funding winter around the corner, given this heightened global economic uncertainty?
Thanks for having me, Sri. So I think there are two levels of fundraising. There are folks like us who are fundraising. The managers themselves have to raise money. And you have dedicated Indian managers. Of late, there's been a lot of love for Indian private equity. I think it's done well. And so I don't see a slowdown for the best managers in Indian private equity. And India has also been an area of interest and renewed focus for a lot of global managers or Asia managers who are allocating more to India because they see it as one bright spot in this global war, both because of the China backlash and because, there's no other large market in the world the size of India. So I don't think there is long-term pessimism at all. I think it's long-term super optimistic. There will be some short-term speed bumps because of all the factors you wove in. So there is always hesitation when there's uncertainty. People are not in a tearing hurry to write checks. So people be cautious. But I don't know if you know this, but some of the best PE funds in the country have raised record-sized funds. Even within venture, if you look at folks like us or a peer group or the folks who are American brands which invest out of India in venture, most of them have actually been successful in raising follow-on funds. And we are on the way as well at Bloom. Hopefully in the next few months, we'll have our fundraise done as well. Now, if you look at, therefore, the dry powder, as they say in our industry, there is enough to be able to finance the early onset of technology ventures, and that's what predominantly venture does, in India up to Series A and B. The problem is when you go to growth. When you go to growth, in the RARA days, you used to have SoftBank and Tiger and Coatue and all of these people plowing money, thinking the big boom is around the corner. And I think most have realized that India, after a certain stage, you either focus on profitability or you can keep burning money growing. And yes. I think people have become cautious there and are pushing companies more and more towards the profitability end of the spectrum and pushing them to get to the public markets. And therefore, if you have raised a bunch of capital between Series A and B, which I think the market is fairly robust for and will continue to be, you've got to be careful about whether you have the metrics to be able to command the Series Cs and Ds, or do you have to start planning towards a path to profitability or going public earlier than ever imagined before the pandemic. So that's kind of my high-level take, Sri.
Understood. Karthik, so you remain optimistic and confident about the animal spirits and the long-term prospects, although there may be speed bumps in the here and now. Yeah. Bloom was the first ever VC in India to fully raise its first fund from domestic investors. Can I ask you how close you are to raising your fifth fund, and would that take Bloom's total AUM closer to that magic $1 billion mark?
Yeah, we hope so. Too early to say. I think there's 4 or 5 months of work. And Indian investors have been bullish, but they also get disappointed a little quicker than long-term global institutional investors, in the sense that they want to see return cycles faster, and therefore they tend to gravitate towards slightly later stage assets, and we are early stage venture. So we've had enormous support from India, from within India, like you said, from that very first fund. But I think that will slow down a little, and we're still going to be, like always, dependent on lots of foreign institutional money also backing us. And that, I think, is in a zone of uncertainty today, given the global environment. Does somebody has to pull a trigger next week just because I'm closing. I don't think anyone's in a hurry. So I think that people will pace it, but for the first time in many quarters, I've got inbounds in the last couple of weeks saying, hey, there's a lot of interest now in trying to understand India a little better. We'll try and come down and meet you next month. So, that hasn't happened in a while for at least a new manager. If we do get to close to that 300 mark, which is what we are aiming for, 250 to 300 million in our fifth fund, which is about the same size as our fund 4, then it should put us, as you said, within like arm's length of that $1 billion magic mark. We are also working on, like every VC manager in the world, it's not peculiar to India. Everyone's working on trying to generate what's called DPI in the industry, which is basically distributions. And if distributions have to be managed through 3 ways, and trade sales are minimal in India. So it's either IPOs or secondaries. And when you do secondaries, a lot of the guys buying the secondaries don't want to take concentrated risks. So they actually ask you to build a portfolio for them and continue to manage them. So that also comes under the AUM. And hopefully, if we pull off a couple of those, then we hit the $1 billion mark.
And Karthik, we will talk about the IPO pipeline later on in our conversation. But in the here and now, can I talk about some of your investments, including Namayatri? It's a ride-hailing app, but with a zero-driver commission model. I've got to say, competition is intense and intensifying in India in that space with Ola and Uber, and now with the government launching Sakar. What gives Namayatri the edge, and how much confidence do you have in this investment?
Yeah, no, actually, so I think when we invest, as you know, Sri, it's mostly Series A or before that. So obviously it's riding on 10-year optimism, not on 1 or 2 year sort of immediate impact. We think this is the future of ride-hailing in India. You missed out a big competitor there called Rapido. They're actually eating into Ola's market share even more than Uber's or they've actually adapted the Namayatri model very cleverly, very quickly, because they already had original ride sharing for two-wheelers when they started. And then they've adapted very quickly to four-wheelers, and they're doing very well also. So it continues to be a competitive market. It will be in India. But I think our worldview of ride-hailing is somewhere in the friction between, government intention to make this sort of a part of the public transport narrative, as opposed to being just cool private transport. Like many things in India, the government will start encouraging models of this nature as they want to expand reach beyond just office goers and city dwellers. So,
yes.
When you think of Uber and Ola, it still feels like, relatively speaking, a niche offering, meaning, 50 million people, 100 million people, whereas India is billion and change. Now, when you want to make cab transport and auto transport and like multimodal, like why should you think about multiple tickets from going from point A to point B if you're taking the metro, for example? All of that can be cleverly woven through the Namayatri model. So Namayatri is like, determined to say that, hey, we can work with the government, much like the government has pushed UPI and UID, what's called digital public infrastructure in India. Actually, if you think about Namayatri, it's trying to ride on digital public infrastructure and make, this kind of transportation far more accessible and more reasonable. So rather than bloating up, let's say, a $400 ride to 500 because you have to pay the platform commission, imagine if that 400 was directly pocketed anyway and goes to 425 and into the driver's pocket, and the customer saves 75 rupees too. So it's a win-win-win for everyone. And, if that means we get a much lesser fee, we're still playing on the volume game, and we're not actually getting into asset ownership. And you're playing like a technology play. So it's not like saying, it's like saying UPI is bad for the country. It can't be, right? I mean, it basically created frictionless payments at a scale no private entity, no Visa, Master, RuPay could have ever done, or a PhonePe, Paytm could have done, unless the government intervened. So we feel it's a clever way for the government to start opening up infrastructure which allows for access to 5, 6, 7, 800 million people. That's the number of mobile data connections we have in India. So why shouldn't everybody who has a data connection get access to something as basic as public transportation? So we think it's a big move in the right direction, but it's game on. I wish there was certainty around early stage investing.
Absolutely.
We'll know
and Karthik, Karthik, please elaborate on how government fits in to your expanding portfolio of mobility from ULO to ULO Motor, and specifically, is the government's FAME 2 subsidy programme really incentivising new innovation and investments, or does more work need to be done at a top-down policy approach level?
I think they can do more. I think their focus is always on, again, things that they can control. So FAME 2, for example, is focused on intracity bus transportation, for example, right? And that's where they think they should move to electric entirely. It reduces pollution in the cities. That should be a big thrust. And there should be a big motivation to actually push electric on everything which is intracity cargo, whether it's people or goods. Why are we still on diesel is unfathomable to me. So I think our view, and when we played, whether it was Euler Motors or whether it's Battery Smart, which does two-wheeler, three-wheeler battery swapping, we have a company called Vecmocon, which does better components for this universe of electric vehicles. These are all our thesis around it's inevitable. There is going to be by 2030, you're going to have almost 80-90% of all intracity cargo, whether it's people or goods, be driven on electric vehicles, because we can't afford the fumes and the pollution and the congestions of what they cause in the city context in India. And broadly, the costs also coming crashing down. So it starts becoming more and more viable, and it's like all the paradoxes you hear around innovation costs, like Jivan's in AI. I don't think they're very distant from applying that to things like electric vehicles, right? And so the more adoption, the more infrastructure gets built, and there it's physical infrastructure. You can't manage like what the government did with digital infrastructure, and they know they can't be the subsidized cost for digital for physical infrastructure. So they have to make it available and easily accessible through private partnerships, right? And so if they don't incent private players to actually put up, EV infrastructure, this thing takes too slow. It goes too slow.
Karthik,
so I think that's where we're headed, in my
Understood. And Karthik, pardon the pun, but it hasn't been an entirely smooth ride for mobility startups, has it? And EV ride-hailing company Bluesmart is testament to that, blighted by financial misconduct. It's raised governance issues in the sector. Is this in any way systemic? Is this one bad apple? And what can be done from a VC oversight and scrutiny point of view to ensure that this doesn't happen in the future again?
Yeah, this is, I think, this is a one-off. I think there's some history with these founders, and this came out of a spin-off of financed by a public company where the founders sit, and this was run by executives and obviously run very well. The calamity, from what little I read in the press, ironically, there's not too many VC investors in this company. So your point is very valid. So two different points. VCs as professional investors handling other people's money, I think, have this amazing responsibility of also, funding innovation and entrepreneurs that most people wouldn't. But also the vantage point we have is to be able to instill great governance very early in the life of a company, which doesn't happen historically with private equity. For example, if a promoter is bootstrapped or lived through 15 years or 20 years of their life without actually having any oversight and governance from professional investors, their behavior is set. I'm not saying they'll all be bad, but their behavior is set. In venture, you have the ability to influence these young entrepreneurs and therefore build in and bake in this kind of governance very early in the life of the company. So that should be the driver and the interest from every VC to see that there are no such issues as this company goes public, right? Here, tragically, that was not the case, and I think it's one bad apple, and it has nothing to do with. In fact, people will swoop in. I wouldn't be surprised if, as per the rumors, Uber comes and takes over that fleet. There was a small startup in Bangalore called Chauffeur. Maybe they come and take some market share from these guys. Inevitably, that cycle will continue. And, Namayatri is still a marketplace, but who knows? We get some share of the electric space as well.
Karthik.
But I think customers love the service, actually, ironically. So customers are the most upset, more than SEBI and the shareholders, that our beloved services has been handled badly by it.
And let me also add, as a final point, Karthik, that EdTech is beloved, and EdTech can serve a very responsible role in helping the most disadvantaged to get an education and to improve their lives, our kids in the community. Will VC continue to back EdTech, or has the fall of Baidu smeared the reputation of education technology startups?
You're right. I think that people have become very cautious after those setbacks. I think there are 3 big companies slated to go public over the next couple of years: Eruditus, Upgrad, PhysicsWala. So I think everyone's on pause because people have EdTech exposure in their portfolio. So do we. We think one of our companies, Class Plus, can actually also go public in a year or so. And so it's going to be very important and what these companies signal to the entire industry, to be honest. That's part one, because they essentially disrupted version 1 of like how at least most of higher education is done. Most of the things that I mentioned are grade 10 and above. K-12 has its own challenges, historically, because of the way Indian education rules and laws are set. There's a separation between the school system and like what technology supports it at the back end. I think we are sitting with AI around the corner. I think we're sitting on a very unique opportunity to rewrite EdTech. I feel education as a whole, I meant. EdTech is just a tool, right? And I think
yes.
the government actually should probably take advantage of this opportunity and see whether they can create
Absolutely.
something as disruptive as they did with payments
Karthik?
and ID and go for it.
We're just out of time. We would have loved to talk to you about quick commerce and whether it's a fad or a growing market opportunity. We'll save that for another occasion. Thank you very much indeed for joining me, Karthik. Karthik Reddy there from Bloom Ventures. We are back in 2 minutes. Quick look at the Asian markets, and there is something of a de-escalation narrative going on, but it's not really being felt in some parts of Asia. With regard to the Nikkei 225 on the defensive by more than 1%, TAIEX down by 1 1/3, and Thailand just wobbling a little bit at that level. And as far as the Indian markets are concerned, we are counting down. We're about 15 minutes away from the market open for the major benchmarks. And if we take a look at Nifty futures, they are suggesting an opening number in the region of 23,837. There are 2 main drivers over the course of this week. The first one is JD Vance's visit to India, 4-day visit, official visit, and whether that advances the BTA. And then, of course, we really hit the main stride of Q4 earnings. Right, let's bring in CNBC TV 18's Ladha Venkatesh now, who joins us from Mumbai, and for more on the prospect of bilateral trade agreement advancing. What's on Vice President Vance's agenda, and is this expected to help the ongoing trade negotiations and give them momentum, Ladha?
It is very much on top of the agenda, the ongoing bilateral trade agreement. But it's a little more than that. There's cultural angle because Vance is coming with Mrs. Usha Vance, whose origins can be traced back to India a couple of generations ago. And he's coming with his 3 children. There's also a big diplomatic team coming with him. So, of course, the meet is expected to cover both the economic cooperation as well as geopolitical and strategic matters. We must remember that this visit, it cannot be a coincidence that it is coming alongside President Xi's visit to a number of Southeast Asian countries. In India itself, the Vance visit was just preceded by Tulsi Gabbard, who came to India for another conference. And before that, of course, two months ago, Prime Minister Modi visited the US to meet President Trump. So it looks like there are some spheres of influence that are also developing, given the breakdown in trade relations between the US and China. The visit has to be seen in that diplomatic context as well. But clearly, on top of the agenda is the economic cooperation and the bilateral trade agreement. The agreement itself may take a long time, but some ground rules could be laid in the meeting that Vice President Vance will have with Prime Minister Modi later today. It's a dinner meeting, and the entire diplomatic force, the External Affairs Minister Jai Shankar, the National Security Advisor Ajit Doval will all be there from the Indian side. So it's a heavyweight meeting, and the expectation is that some of the trade issues will be discussed. Trade tariffs, trade deficits, and the kind of things that India could buy from the US, maybe energy and military equipment. All that is expected to be discussed in the meeting. But separate from this is, of course, the cultural program that's been drawn up for Vance. He, of course, goes to see the Taj. He will see he'll be also going to Jaipur, which is another very important historical city. He's going to visit handicrafts, exhibitions. So there is a cultural visit as well that's merged into this. Otherwise, purely economic cooperation visit.
Ladha, excellent. Thank you very much indeed for that. And we can count on you, I'm sure, to keep us updated throughout JD Vance's visit to India. Thank you, Ladha. Now, after meeting the US Vice President today, Prime Minister Modi will be heading to Saudi Arabia. Dan Murphy is joining us now from Dubai with more details on his visit. Good morning, Dan.
Good morning to you, Sri. Well, that's right. Prime Minister Narendra Modi actually heading to Jeddah in Saudi Arabia on Tuesday. This is going to be the first visit by an Indian leader to Saudi Arabia's commercial capital in over 40 years. But this is also Prime Minister Modi's 3rd trip to the kingdom, but his first visit to Jeddah. It comes as India and Saudi Arabia try to advance their already existing BRICS relationship into key areas like defense and energy and technology and investment. So several new deals are expected here. What they look like, of course, remain to be seen at this point, but we're watching for news flow in the energy space in particular. India, of course, being the world's 3rd largest oil importer. Saudi Arabia is its 2nd largest supplier. And behind the scenes, our sources are saying officials are expected to try and hammer out new deals across upstream and refining, and possibly even strategic reserves here. At the same time, Modi's visit also builds on the India Strategic Partnership Council, which was launched last year. This includes a dedicated energy pillar. And of course, we've also seen Indian investments in Saudi Arabia ramping up as well. Saudi Arabia's Public Investment Fund also has major investments in Indian corporates like Reliance Jio and Reliance Retail Ventures. So we're looking out for any new investment deals as a result of this emerging and really geopolitically interesting partnership between India and Saudi Arabia rapidly evolving, Sri.
Dan, excellent. Thank you very much indeed for that. Let's take a look at the Forex markets and with particular reference to the Indian rupee, of course. This is where we are standing in terms of the dollar-rupee exchange rate. 85.0980 is where we are trading. Remember that the rupee closed on Thursday at 85.3675. That's up nearly 0.8% on the week. And in the near term, dollar rupee is expected to trade between 85 and 85.80. The US dollar has been broadly weaker, that dollar weakness helping to support currencies like the rupee, which could help mutual fund flows into the domestic Indian market. Right, let's bring in Ruchit Mehta now, Head of Research at SBI Mutual Fund. Ruchit, thank you very much indeed for joining me. How closely would you say the Indian markets are watching J.D. Vance's visit this week as a positive catalyst insofar as it might breathe some life into some momentum associated and getting us towards a bilateral trade agreement?
Yeah, you're right. I mean, getting a trade agreement in place would be quite helpful. The Indian government has been working with the US counterparts for quite some time to get some sort of an agreement in place. Now, you have certain areas that would be of interest to India from the US side, which is, for example, imports of military equipment, energy imports as well. And also from an India standpoint, making sure that there's clarity with regards to, say, tariffs on, say, pharmaceutical products or automotive exports, because that's a key export from India. So any sort of an agreement or getting closer to an agreement would be quite positively viewed by the markets.
Thank you for that, Ruchit. I just want to play you a soundbite from an earlier guest from Nomura. He was talking about foreign investor perceptions towards India. I'll play you that soundbite and then we'll get back to you.
India has come off from an extremely strong position in an equity market. I think it's looking far more interesting as an investment perspective. Long term, it's fantastic investment that we've liked for ages. And we think any positive news around India is another opportunity to buy into the space.
Ruchit, what do you think? How do you think foreign investors are approaching the Indian market now on a relative valuation basis, given this recent drawdown and given this tariff narrative and the tariff arbitrage and differential, which appears to be working in India's favour, 26% versus 125%? Is this once again buy India, sell China territory?
Well, last year there was a lot of sort of sell India, buy China, and driven more so by the valuations over there. So you're right, valuations have become a lot more attractive. But I think from a longer term perspective, what works in India's favor, given the current sort of tariff wars or trade wars, is that India is a net importer, right? And from that standpoint, any sort of tariff war, trade war scenario is likely to be positive from an India standpoint. Over the medium to longer term, India continues to offer to investors a fairly solid domestic growth story. Our consumption is highly domestic. We have a lot of sort of domestic demand momentum picking up, and longer term growth can be pretty solid. So from that standpoint, I think India is a very attractive market, particularly given that now valuations have come off quite a bit since the markets have corrected since early January.
Several major companies, including Reliance Industries, Tata Communications, Tata Consumer, Axis Bank, are going to be reporting this week, Ruchit. What do you think they are going to tell us? And is there any inherent guidance risk, perhaps, that the market needs to price?
Well, I think from the banking sector standpoint, we had a couple of results over the weekend, HDFC and ICICI. I think the numbers have been pretty solid and the outlook looks a lot more interesting. I think going forward, you should see banking as a sector continue to do well. Anything that's going to be more export oriented, be it exports out to the US, like IT services, or anything into the European markets, is going to be disappointing in the current quarter in terms of the guidance outlook, because just the sheer uncertainty of how trade itself will play out, what sort of the tariffs are going to be implemented, it's going to be quite difficult for companies to even provide some bit of a guidance. So all the domestic-oriented names are going to look a lot better. And particularly within there, I think the Indian banks seem to be looking very, very attractive. Valuations have been pretty solid. They have underperformed over the last 3 years. The RBI has become a lot more accommodative. They've been pumping in a lot of liquidity into the markets, and you're starting to see some bit of demand momentum come back. Like, HDFC reported a 14% deposit growth and similar-ish, loan growth as well. So, you see pretty solid momentum coming in for the banking side. So there, I think you could see positive surprises.
Can I dig a bit deeper into the narrative and the guidance from the banks, Ruchit? And if you are constructive on the sector, what names can you give us in terms of what could appear on your conviction list?
I think we generally do like the private sector space as well. So all of the private sector banks look pretty attractive. Within the public sector space, the larger banks are looking quite attractive as well. There are capital market plays as well, which could be interesting. The asset management companies, and as well as some of the associated, ecosystem names, particularly, let's say, for example, credit rating agencies, that they look quite attractive. So I think overall, we would stick with the larger banks, both in the public sector as well as on the private sector side of it. NBFCs, you gotta be careful. Choose guys which have a robust enough balance sheet and a much more diversified loan book to see the growth momentum continue. So NBFCs, be a little bit more selective there.
Understood. Richard, getting back to your point about the pharma, about the export sectors being the most vulnerable in this environment, pharma may be in line for major sectoral tariffs from the US on national security grounds. So should we be reducing exposure to names like Dr. Reddy's, like Cipla and Sun Pharma?
Well, the threat of tariffs is there, but I think, if you look at the broader landscape of where do you get alternate supplies from, and at the cost that the Indian manufacturers are able to provide, there are fairly limited sort of opportunities to diversify away from the Indian landscape. Secondly, I think, from an input cost perspective towards the end drug price, it's not going to be as material as it is going to be, for example, say the automotive sector, right? 25% tariff on, say, automotive component exports is going to be a lot more expensive than, putting, let's say, similar 25% tariff on, say, active pharmaceutical ingredient export. So I think while yes, there is this uncertainty with regards to the tariffs on pharma exports, but I think eventually, given the nature of India's ecosystem's importance to the pharma industry in the US, and the fact that there have been positive discussions between the Indian and the US side, I don't think it will be that big of an issue for pharmaceutical exports out of India.
I see. And does the same go for IT services? And should we avoid those names with exposure to the North American market for the time being, given the prospect? I know that they're not necessarily at the sharp end of tariffs, but given the prospect for slower growth or even recession in the United States and the fallout, the associated impact that could have on the likes of Infosys and TCS from an enterprise spending and demand point of view?
Yeah, I think more than tariffs, I think the uncertainty with regards to the business outlook is going to be a lot more challenging for the IT firms. I think we've already seen some bit of commentary with regards to that. I think the bigger challenge for these companies is that in an environment where you just don't know how business is going to shape up, clients are going to want to sort of hold back on any major expenditure programs, particularly on the discretionary side. You're going to be working with more of keep the lights on kind of projects rather than saying, okay, we're going to do some bit of new projects or some new technology that we're going to try out. So it's going to be a fairly bit challenging from that standpoint. And obviously, all of the developments on the AI side of it, clients are going to come around and say, look, are you using these tools to create some bit of productivity gains, and you need to pass them back to us. So I think for tech, more than the headline tariff issues, I think it's more with regards to the second derivative impact of how the business momentum per se is shaping up and the uncertainty, which will likely hold clients back from making any sort of discretionary spend. And we've already heard about it. People are cutting back on travel and stuff like that, yeah.
Exactly, and there's layoffs as well, and that's been a theme amongst the IT services companies. FMCG has been a bright spot despite the tariff uncertainty. And this week we will be hearing from a number of consumer bellwethers, including Nestle India, Hindustan, Unilever. What will they tell us, Ruchit, about the broader economy, confidence levels and the inflationary environment?
I think, we're not so greatly optimistic about the larger listed FMCG names in India, right? Particularly because I think what is happening is that for these companies, they're seeing a lot of competition from the unlisted names, a lot of the startups, the new companies that have evolved over the last few years. You had the Blue Venture guys on your show a little while back, and people like them have been funding a lot of new startups, and therefore for the consumer, you're seeing an increase in the number of options available across categories, be it from beauty and personal care to even confectionery and biscuits, etc. And that means that the consumer is now sampling a wider choice than what was available, and that's kind of hurting a lot of the traditional names, the Nestle's, the Unilevers of the world, where they have the pressures of commodity costs and therefore rising prices. And on the other side, you have a lot of these new startups or these unorganized players who kind of are, going more for market share gains and not necessarily for margin at this point. So I think while the aggregate demand outlook is pretty fine, I think it's just that there is a fair bit of action happening outside of the listed universe space, which is denting the listed companies' growth profile.
Ruchit, from a sentiment point of view, mutual fund flows hitting 11-month lows in March. What does that tell you about confidence levels in the market?
I mean, to be honest, the aggregate numbers are still pretty solid, right? We would have thought that February and March data would have been a lot worse than what it actually came through, right? March was still about $3 billion of SIP flows into the markets. It's held on pretty solid. Where sentiment has taken a lot of it is on new fund offerings, and they have seen lesser amount of inflows happening. Generally, I think the Indian retail investor has become a lot more astute. They are happy to ride out the volatility that's there in the markets. Mind you, a lot of the investors are sitting on fairly high amount of gains over the last 3-4 years that's there. So many of them are just happy to just sit by. And in fact, we don't think that material impacts could come on the retail flows in the coming months as well. And in some senses, that markets have recovered now. I think April, May should be a lot better from a SIP flow perspective than the momentum that we've seen in February and March.
Ruchit, do you have a line on how we should be approaching the listed defence names, defence sector? Because we know that India may be offering cheap loans for arms targeting Russia's traditional customers. We also know that defence could be part of a bilateral trade agreement between India and the United States. What are the implications then for the listed defence names?
I think the listed defense names are fairly small and limited in terms of the number of opportunities itself. And there is a lot of growth that's already priced into many of these names, and markets kind of have extrapolated a lot of the positive momentum both on the order booking side as well as what potentially could happen by the government in terms of insourcing of demand. So I think while the prospects are fairly robust, but a lot of it seems to have been priced in. We think that from a defense demand perspective, the ancillary space could see a lot better prospect. For example, the forging companies or the bearing companies, right? A lot of them are going to be supplying parts and components into the frontline defense companies per se. So I think it is better to play the derivative names rather than to sort of focus on the headline defense companies, surely because they just have been pricing in a lot of growth and valuations are fairly rich at this point.
And just a line on infrastructure, Ruchit, and do you feel that the government capital spending programme is sufficient enough to really continue underlying the investment case for infrastructure, or do you feel that it's too much of a crowded sector?
No, I think, there has been some bit of rethink in the government in terms of the priority spending. So, while the last decade or so, there's been a lot of emphasis on scaling of road infrastructure in the country, and now you're seeing some bit of pivoting happen towards, improving, railway infrastructure, particularly like say upgradation of railway stations to more modern facilities, expanding airports, focus a lot more on urban infrastructure. So I think it's just a pivot of what was traditionally, have very heavy road-oriented infrastructure spending towards more of other areas of railways and, urban infrastructure. So I think broadly, we're not so concerned. One just has to look at where are the areas of spending priorities happening and kind of look at companies which could benefit out of that.
Richard, we'll leave it there, sir. Always great catching up with you. Thank you very much indeed for those insights. Richard Mehta there from SBI Mutual Fund. Indian markets have joined the trading day, and we're about just over 5 minutes into the trading day in India. We'll look at the movers in Mumbai after the short break. We are back in 2 minutes. Right, let's give you a glimpse of the Indian benchmark stock markets, which are now well into the trading day, and the Nifty 50 is making a run, actually, on 24,000, which is one of the targets, one of the upside resistance targets that's been mentioned. 24,200 is another one after that, if we do manage to succeed in moving through that. It's really a day off the banks that are leading the broader index higher. Let's take a look at the exchange rate, dollar rupee at 85.11. So that is looking constructive as well in favour of the Indian rupee. We've seen that weakness in the US dollar, so the Indian rupee on the incline, another way of looking at that cross by about 0.4%. We were talking about, Ruchit, how the bank's narrative is looking quite strong at the moment in the current environment. We are watching the shares of India's largest private lender, HDFC Bank, getting a chance to react to their latest earnings. That stock up by almost 2%. This after CFO said that they aim to bring the bank's loan-to-deposit ratio down to 85%, 85 to 90% in 2026-27 fiscal year. HDFC Bank's fourth quarter net profit came in at just over $2 billion, beating expectations. Moving on to ICICI Bank. That stock is up by over 1%, having a strong day after it reported an earnings beat, posting a higher than expected 18% year-on-year jump in its quarterly net profit to reach nearly $1.5 billion. Total loans were up close to 14% in the fourth quarter, and deposits grew by a similar quantum. Private lender Yes Bank also surging in trade today after beating quarterly profit estimates. The stock there up by almost 5%. However, the tech space, the laggard, Infosys posting a revenue miss in its fourth quarter, which could further weigh on its stock. The IT services major also giving a weak annual outlook as clients turned more cautious in their spending amid the ongoing trade disruptions. However, Infosys in the here and now seems to be shrugging that off, up by 1.25%, however, down quite sharply on a year-to-date basis. IT giants also taking some relatively disappointing earnings in their stride as far as the market perceptions are concerned. And in the money, Infosys, as we said there, leading up by about 1.5%. TCS and Wipro having a relatively less favoured start to the day, but still trading in the plus column. That's it for the show today. Tomorrow we will track the latest from US Vice President J.D. Vance's meeting with Prime Minister Narendra Modi. Also a focus on markets with Hiren Dasani of Goldman Sachs Asset Management, and a look at India's evolving crypto space with CoinSwitch. Don't miss it. That's all the time we have today on Inside India. Dan Murphy is up next with Access Middle East.